Hey guys, welcome back. In today's episode, our discussion will focus on one of the hot topics in this price action course. The simple reason being, this topic is what helps a price action trader identify the critical price levels and decide with the entry targets and stop losses. The support and resistance are one of the key factors that distinguish between your success and failure in trading. Starting off, the support and resistance are specific price points on a chart, which is expected to attract maximum amount of either buying or selling. The support price is a price at which one expects more number of buyers than sellers. Likewise, the resistance is a price at which one expects more sellers than buyers. So as the name suggests, the resistance is something that stops the price from rising further. This is a textbook definition that you can find in any standard trading book. Let's dig deeper into this topic. Let us understand why some price points behave in this particular manner. We have talked about the fact that stock market runs on demand and supply. This very concept is what causes some price levels to behave as a barrier or some as a booster for the prices. Take an example of a stock trading at 125 rupees. Let us say that an institution thinks that the stock will do good in the upcoming quarters, but the fair price is 100 rupees and not 125 rupees. In order to achieve the fair price, they take the market down to 100 rupees, where they slowly and steadily build their positions. The price seems to respect the price level of 100 rupees. This level where the demand for the stock is met and from where the prices will start to rise is called as the support level. The support level can also be seen as a price level which holds the prices from falling further down. It is also an area where the big buyers will buy the stock. Due to a large number of buy orders at the support level and the lack of sellers to match all the orders, the price starts rising from the support level. A price level is said to be a support level when it is below the current market price. Now moving on with the same example, the price rallied from 100 rupees to 200 rupees in a matter of months. This is when the institution thinks of squaring off their position or selling the stock to make a profit. They do this by placing a large number of small sell orders so that the supply meets the demand, or in other words, they ensure that there are enough buy orders at the same price at which they want to sell so that the profits are not reduced. This particular price level will look like it is stopping the prices from moving further up. So this level is known as the resistance level. The number of sell orders in this price level is higher than the number of buy orders, or the supply is higher than the demand, due to which the prices start to fall from this level. A price level is said to be a resistance level when it is above the current market price. As a trader working in any time frame, it is important to figure out the critical levels where there was some price action. By identifying the important price levels, you can make more successful trades using the price action technique. Let us learn how to draw supports and resistance in our chart by a simple 4-step process. In short, these 4 steps are loading the data points and zooming out, identifying the obvious price action zones, aligning the zones, and fitting a horizontal line. Now we can take a look at each of them. Step 1 is to load the data points and zoom out. After selecting your preferred time period for the trades, you want to zoom out your charts. This is because we want to see the bigger picture. Once you can see the big picture, it is much more obvious to your eyes which key levels should you be paying attention to. So if your objective is to identify the short-term support and resistance for intraday trading, then you must load at least 3 to 6 months of data points. And if you want to identify the long-term support and resistance for swing or positional trades, load at least 12 to 18 months of data points. So when you load more number of data points, the chart looks more compressed. Moving on to the second step, we have to identify the obvious price action zones. A price action zone can be described as sticky points on this chart. This is because the level sticks out or is easily visible to your naked eyes. So if the level sticks out, the level matters or it is a level of importance. But if you are doubting your eyes and asking if it is a level or not, then it's better to ignore it because it is not an important level. Just to give you better clarity, you can identify a critical level when the price has displayed at least one of the following behaviors. That is, number one, the price hesitates to move up further after a brief up move. And number two, the price hesitates to move down further after a brief down move. And finally, number three, when sharp reversals occurs at a particular price point. These are some of the ways you can figure out the price action zones. Now moving on to step number 3, aligning the price action zones. Now when you look at a 12 to 18 month chart, it is very common to spot many price action zones by the method that we have just discussed. But we don't have to track down all these price levels. The trick is to identify at least 3 price action zones at the same price level. But a critical point to note while identifying these price action zones is to make sure that these price zones are well spaced in time, meaning there should be a good time difference between the two levels spotted. The more the distance between the two price action zones, the more powerful the support resistance identification, or we can say the support or resistance is a major price level. Now after identifying and aligning your price action zones, we move on to the step number 4, that is fitting a horizontal line. Connect the price action zones that we have identified with a horizontal line. After drawing the line, you have to adjust your level to get the maximum number of touches. The more touches, the better, because the more number of touches, the stronger the price level will act as a major support or resistance. So how do you tell that you have drawn a support or you have drawn a resistance? As we have discussed, if the market price stays above the level that we have drawn, it acts as a support. Similarly, if the market price is below the level that we have drawn, then it will act as a resistance. Here's an important mistake that most traders make while plotting the support resistance levels: the approximation risk. Generally, when identifying the support resistance, you run into approximation risk. The thing to understand is that the market will not respect just a single price level, but rather a group of corresponding price levels or an area of prices. So hence, we have to give a room for error, which means that the price level should be depicted in a range and not just as a single price point, which simply means that rather than drawing a single line to plot the support resistance, we should represent it as a zone or an area where there is a price action happening. So this is a very important idea to remember when you are placing the targets and stop losses while trading the support resistance levels. Especially if you are keeping stop losses with respect to a single support or resistance line, you might end up hitting your stop losses often. Let us talk briefly about how reliable the support resistance are. The support and resistance lines are only indicative of possible price reversals. That is, by no means we can be certain that a reversal is going to happen, which implies that the support and resistance alone are not the holy grail to success in price action trading. Rather, a few optimization techniques will help us identify high quality trades. Remember the fact that when you seek quality, the quantity will always be compromised, but this compromise is worth taking. The idea is to identify quality trading signals as opposed to identifying plenty of worthless trades and ending up bursting your pockets. This leads to an important idea. So what if we have a checklist or a framework for every trade that we consider? The checklist would act as a guiding principle before we initiate the trade. The trade should comply with the conditions specified in the checklist. If it does, we take the trade. Else, we drop it and look for another trade opportunity that complies with the checklist. Not only that, We should not make a habit of just trading with a single confirmation. That is, if the price reaches a support or resistance, we should not jump into the conclusion that the price would reverse the direction and we should enter the trade. It does not work like that. Instead, what we should do is that we should look for confirmations. In the previous episode, we have talked about price action candles, which are very important. It is generally a very good idea to use some of these price action candles along with the supports and resistance to actually make a trading system. That is a confluence trading system, which is much more efficient than using a single indication or a single confirmation. So make your own system and create a checklist, because the checklist has another advantage. It helps you to be disciplined, because discipline, as they say, makes up 80% of the trader's success. So in my opinion, the checklist forces you to be disciplined. It will also help you to avoid taking an abrupt and reckless trading decision. So we will continue this discussion on support resistance in the upcoming episodes, because it is an extensive topic requiring a deeper understanding. I will catch you guys in the next video. If you learned something new, like the video and subscribe to the channel so that you don't miss out on the upcoming videos.